And good day. This is the Eye of the Storm podcast with the big picture update for Saturday, April 29th, 2023. Tonight, I'm going to update and cover the SPX, the NDX, the 30-year bond, 10-year note, and 2-year note, gold, and the US dollar index. But before I begin, just kind of want to do a little bit of a big picture recap of what we all went through last week. It was an amazing week in the equity markets. It was an amazing week in the interest rate markets. It was an amazing week in development of our ongoing and hopefully not so big building banking crisis, with the tone being set by both sides and really just giving us, I don't want to call it false information, but possibly false hope that everything's under control. And then we saw a large drop in the M2 money supply as it's reported on Thursdays at 4:30 p.m. Eastern. And when I took a look at the chart of this, it was pretty amazing in that the M2 money supply has dropped quite a bit and gone negative. And the last time that this measurably happened was in 1929. Now, for those of you that may not understand or know what the M2 money supply is, it is a reading that is kept by the Federal Reserve, and it is a means by which the government can measure the money supply, which at the time when it's taken includes cash, checking deposits, and other types of deposits that are readily convertible to cash. So we can go a little bit further and talk about, there's several. There's an M1, M2, M3. The Federal Reserve tracks a separate money supply number, and that's called the M1, and that includes our currency that's in our pockets or in our checking accounts and savings accounts. The money that is deposited into time deposits and money market funds is not counted in an M1. So for the Fed's purposes, this near money, and that is funds that cannot be used as a medium of exchange, and they are not instantly convertible to cash. That's M1. Now, M2 is the U.S. Federal Reserve's estimate of the total money supply, including all of the cash we, as the people, have in our hands, plus all of the money deposited into checking accounts, saving accounts, other short-term saving vehicles such as certificates of deposit, retirement account balances, and time deposits, all above $100,000. So retirement account balances and time deposits above $100,000, those are not included within the M2. Those are included in the M1. So again, M2 is a measure of the money supply that includes cash, checking deposits, and other types of deposits that are readily convertible to cash, such as CDs. M1 is an estimate of cash, checking, and savings account deposits only. So the weekly M1 and M2 numbers are closely monitored as indicators of an overall money supply. Too fast of growth in those numbers can be a warning of inflation. What would the opposite say? So another money supply number, which is the M3, includes all of the above plus institutional cash deposits. Those numbers are only published quarterly. Also, just so that we know, gold, gets interesting, gold is not counted in M1, M2, or M3. So in our modern world, gold is no longer used as a common currency. That I have been talking about. And that, I believe, is changing again. And primarily, basically, because when we start to see outstanding, we begin to see that fiat currency is beginning to go by the wayside. It is still in force, of course. So within the United States of America and all countries that issue their own currency, it is not backed by anything other than the good faith and credit of the government of the issuer. So here in the United States, it is our Treasury Department that actually issues our currency, and it is backed by the good faith and credit of the United States. Well, as we watch that begin to decay, what do we think is going to happen to the dollar? Is it still going to have that good faith and credit of the United States? Are we still going to have faith in the credit and the ability of the United States to pay its obligations? Are we starting to see that decay? Are we starting to see the battle lines being drawn, which everybody considers, they'll get over it, which is called raising the debt ceiling, right? If we don't raise the debt ceiling, we are not allowed to borrow additional money as a government to continue to fund our government so that the government can meet its obligations. So what are the ways that they can raise money? Well, of course, we issue bonds. We issue new 30-year bonds. We use 10-year notes, 5-year notes, 2-year notes, a short, even shorter term, 1 month, 2 month, 18, et cetera, all the way out. We have many vehicles which are auctioned every single day in varying amounts, in varying timeframes. The government is constantly rolling and issuing new debt. But when we reach our limit, which will be reached by the month of June, then we are no longer can do that. The federal government, the Treasury, would no longer have the ability to do that because you reached your limit, that's all you get. What happens after that? Well, we can listen to what Janet Yellen has to say because she's Secretary of the Treasury. We can listen to what a lot of people talk about it. But let me just say, the severity of the United States heading anywhere close to defaulting on its obligations would carry with it outstandingly negative implications for the U.S. on the global stage, and for the U.S. to its own people. So it is a serious thing, but, up to this point, we've seen, like most recently, we've seen in 2011, where we went down to the wire before they finally said, yeah, okay, fine, here, you can raise it X trillion dollars. Then we saw it again in 2015. Different administration, et cetera, but went right down to the wire. Now we're confronting it again. And it would appear that they want to just try this gig of coming up saying, that the House of Representatives passed the debt ceiling bill, which will not make it through the front door of the Senate, will never make it to a vote, because what the Republicans in the House of Representatives decided to do is also include a budget. So trying to put the pressure on getting the president and the director of the Treasury and other parties to the table to argue over what they want, which, by the way, when we really take a look at it, has nothing to do with, well, gee, maybe we should be asking corporations to put a little bit more into the kitty. No, we're asking to slice and dice Social Security, Medicare, all of the public assistance, right? And understand that Social Security, which I am retired, so therefore I am entitled to Social Security. But let's not forget, I paid into that fund. And I paid in a fair amount of money into that fund, into Social Security and into Medicare. And then even after, because our same government, our same forms of government cannot go to battle with pharmaceuticals. who insist on that they're going to continue to make billions and billions and billions of dollars by overcharging for medications, which they now know we all need to survive day to day. So again, it continues to pander and just move towards large corporations, right? And large corporations, because thank you to Citizens United, now large corporations can and do partake in our electoral process. Do you know of another country or another place in our world where electing a president can cost over $30 billion just to elect the president? No, I don't. Or to elect senators, we're talking millions, hundreds of millions of dollars, or congresspeople, hundreds of millions of dollars. And they take a cut because they are being backed by large corporations, big money. This is our system. And yet we want to just continue to move forward, but hang on to our piece of the pie. So when we try to just put this all into, what is M2 doing? It's dropping. It's dropping and hasn't gone under the levels that we're now seeing since 1929. What is it beginning to tell us? Are people getting worried about their money? They should. Are they having less of it? Very likely. Now, add to this, we've had this banking crisis on the back burner, just on slow boil. Not on a high fire, just on slow boil. It has not gone away. And now, if we watch the news, First Republic did collapse. Courtesy of the fact that everybody just started bailing on the stock. Oh, it had nothing to do with it, right? Because, well, their deposits are guaranteed. Well, we had those 6 or 7 banks contribute $30 billion to First Republic's deposits, blah, blah, blah. So the FDIC has taken it over. And again, the FDIC is asking for JP Morgan and PNC Financial Group to table their final bids for taking over First Republic by Sunday. So that's tomorrow. This is what the FDIC is asking for. Then we're just going to go, okay, highest bidder, you get it. Now let's just go back to JP Morgan leading 5 other banks and putting all this money in to the deposits for First Republic. And then standing by and watching First Republic drop 33, 36, 38, 40%. They halt the stock, they reopen it, it drops another 20%. They halt the stock, they reopen it, et cetera, et cetera. So, the stock traded under $3 on Friday before they finally got a little bit up, stopped the trading, and just halted it, and the bank has collapsed. The bank is now in receivership at FDIC. And now they need someone to take it over. Gee, so glad you put in your $30 billion to stabilize that bank while you put together your bid to get it at rock bottom prices. And then handpick likely the deposits that you're going to take with you, the accounts that you will take with you, JP Morgan, that you will take with you, PNC. That maybe gets also spread out amongst other banks. So it's not a very, very rosy picture for our banking system when the troubled banks suddenly become prey for the larger too big to fail banks, who have then again become too bigger to fail. So when we take a look at things, it has been reported that approximately 200 banks within our nationwide system are at risk of failure. So who do those include? A lot of regional banks, number one. So, but they're at a risk of failure if depositors ever get spooked. So think about that. So the U.S. banks have $2.2 trillion in unrealized losses due to the rising interest rates. Here comes another component, folks. Oh, the Fed can't. The Fed can't keep hiking rates because they got to save the banking system. How are that supposed to happen? By letting inflation chew up the rest of us while we save all the banks? Because if they continue to raise the interest rates, those losses grow. So if you think right now that 2.2 trillion, remember how much got injected into the system, folks? 21 point something trillion so far. That's our Federal Reserve and Treasury injecting stimulus in there. Why? Well, to prop up the country, to prop up the system, to prop up companies, to give us as citizens a chance to kind of like get out there and work. Well, guess what's happening? The money supply dropped. The M2 dropped. So all of our money combined, our available cash dropped. Where did it go? Think about that. Where did it go? Case in point, this past week, on Wednesday, we saw a massive amount of money being pushed back into tech. Now, whether that's a rotation, whether that's just end of the month, which technically we saw yesterday, an end of the month, right? There's always going to be a rotation. And under what do you like? What do you don't like, et cetera, et cetera. Asset managers making their adjustments, which is their job. That's what they're supposed to do. They're supposed to prepare your portfolio that they're managing for anything that happens in the market. If the market's going to go down, their portfolio should go down less than they've done their job. If the market's going to go up, their portfolio should go up even more, a larger percentage than they've done their job. So maybe there's a lot of money that's been just tossed back into the markets. I don't know. So, but we have a lot going on. So, in essence, what we have going on within our banking system is one solution, which is consolidation. The larger, the bigger, which we continue to label too big to fail, banks are beginning to swallow the weaker banks. But guess who they're leaving out, who they don't want to have an interest in? What they're now labeling as the zombie banks. There's a large amount of banks out there that no matter how much money you want to inject into them, it won't help. It won't help. If we raise the interest rates, they're going to turn into a zombie because guess what? Deer in the headlights. Oh my God, what do we do now? We have all these positions. We can't sell the positions because it's such a huge loss. It's turning into a very ugly decision. So to really believe and to think that the banking system is A-OK, no. I doubt that. I doubt that very big. Now, one last thing I want to toss in before I start to go over these pictures. Commercial real estate, again, remains, in my view, the 800-pound gorilla in the coal mine, not the canary. The canary died a hell of a long time ago, and no one even noticed. So now they've decided, well, what can we put in there? Well, how about this 800-pound gorilla? Let's stick that 800-pound gorilla into the coal mine, and when he dies, maybe we'll all notice. Okay, but the 800-pound gorilla in the coal mine right now is commercial real estate. Now, again, as you know, and maybe you don't, if you're a first-time listener, I live in the city of San Francisco. It's an extremely wealthy city and still is an extremely wealthy city. The median price for a fixer-upper, folks, not a house that you're really going to fall in love with and is sitting in a ritzy neighborhood, a median home in a not such a nice area of San Francisco is $1.6 million. That's what it costs. So if you want to go over and live in what we call the really beautiful neighborhoods, aka Pacific Heights, Presidio Heights, Sea Cliff, these are neighborhoods, those are Tony neighborhoods within our city. where the homes are priced, I don't know, I've seen them go as high as 25, 35, 45 million dollars. Now, they aren't trading and they're not buying and selling as quickly as we've seen in the past. But even when we have to drop down to other just normal, and I put quotes around that, but normal neighborhoods, people with, we're all working. Maybe we're getting $250,000 a year, et cetera, et cetera. Those homes, 4.5, 5.5, 6.5, $7.5 million. And we're just talking about houses that are grouped together. You don't get a big yard. We got, all of our neighbors are touching. You might have a front yard and a backyard, but it's not a huge lot. Here we are. This is San Francisco. Commercial real estate in San Francisco continues to clock very high vacancy rates. 29.4% is the latest number, and I just got that this morning. 29.4% vacancy rate. Now, I want to just show you one thing, because often you hear me talk about very, very large asset management firms. Blackstone, which has a lot of ETFs and a lot of things of that nature in investment, but also has a very, very large private equity arm. And they own several buildings right here in San Francisco. So there are very large tenants. And one of the buildings that they own has 2 towers and has 1.6 million square feet of office space available. So right now, it was announced that Visa and Autodesk are looking to sublease their space. And by them doing that, and it was space in these 2 towers that are owned and managed by BlackRock Private Equity, just in the building, raised the vacancy rate in the building to 16.4%. Within San Francisco, Google currently leases, I believe actually in that building, the 2 towers building that I told you about, they're currently leasing 339,833 square feet of office space in San Francisco, of which I'm to understand they would like to sublease some of that. Meta, aka Facebook, is looking to sublease 435,000 square feet in a new luxury building in downtown San Francisco. They're getting no takers there. Salesforce, our crown jewel here, is looking to sublease 125,000 square feet in the tower that bears their name, and also another one, which is just basically across the street from the Salesforce Tower, 104,000 square feet. We're not getting any improvement in this vacancy rate, folks. They're not lining up to try to pick up this real estate in downtown San Francisco. The only good news is that Visa, which is vacating one building because they've agreed to move to another so they can have additional space versus what was available in that tower that I just mentioned. So they're not necessarily leaving the city. They're continuing to be based here, or have a large part of their business here in San Francisco. They're just moving it to another new building that is now ready. So putting that all together does not necessarily spell a continuing building bull market. It just doesn't fit. When we're considering that we're launching off of a low, it's got to have a really strong base economically in which to launch, a lot of prospects in which to go like, oh, wow, this is a strong sector. This is a strong sector. Here we got. But yet, what did we hang our hats on this past week? We hung our hats on Google, Metaverse, Microsoft, all reporting. Now, Microsoft, they say, what, it blew the doors off. Okay. And what did it do? Popped above 300. And when it got up there, which, by the way, new 52-week high, the stock took out all these stops. They went on a big stop run to get it all up to 310 before finally settling back down. All about trading. Metaverse, yeah, loved them. Great earnings, right? Somehow they managed that their ad growth was 26%. Based on what, I'm not sure. When Google, which does have, I think, a high percentage of ad sales and ad revenue, showed a decline. Interesting. So they're all going over to Facebook or Metaverse to advertise versus Google, which uses YouTube plus what they put on the web. I don't know. What can we say? Then came Amazon. Interesting story, Amazon on Thursday, wasn't it? If you stood around and you decided to play. Amazon reports on Thursday. Their earnings were okay. They beat by a little bit. Their revenue, okay numbers. Everything looked in line. I think on purpose, Amazon waited an hour and a half before they sat down at the table to have their press conference. And then within the press conference, they decided to go, oh, by the way, in our Amazon Web Services division, well, corporations and companies are really starting to pull back on that budget and on what they're willing to spend. And so we did okay. We saw a little bit of a drift lower in Q1, but we're expecting a 500 basis point drop in Q2. Well, initially the stock went from 109 to 123. That hit, and it dropped faster than a stone in water, I will say, because it started to appear, where's the bottom of that lake that this rock just got thrown into? And it was like down, and now suddenly the stock we're closing at 109, now it's trading below 109. It did find a floor, and that floor is approximately towards the 105 area. Now, can we wipe out all gains for this year in Amazon? We can. We can, because what we now need to see is a definitive turn in the right direction that every pundit is out there saying is going to happen. Now, again, we have problems, and I just listed them. Now we need to see, what are we going to do about it? What's the economy going to do? How is the banking system really going to find a floor, stop this impending doom? Instead of pundits came out, no, it can't happen. Fed, or having a pundit come out and say, the Fed can't raise interest rates, it'll destroy the banking system. I'm like, who are you? You're now going to dictate what they can't do, when in honesty, what their job is to keep a control on an unemployment and the employment market and interest rates. It's not our job to save the banking system that made their own mistakes, that got themselves into these positions that didn't, and they had no idea how to hedge it against rising interest rates. So in other words, what you're saying, because of the bad trading done by all these banks, now the Federal Reserve can't raise interest rates to put a grip and a control on inflation. Because if we do, then those banks they'll just be fine because of the mistakes they made. Well, what do you think that's going to do, folks, if they decide, oh, yes, we'll get a pop. Oh, Fed pivoted, and all the banks break anyway. So again, the pundits are creating more of a mess than they are helping with a solution. So let's take a look. What did the market do, and what happened according to Elliott in our markets today? Thank you very much for listening to my soapbox, but it's been a couple of weeks in which I apologize, but thank you for your patience as I got over a bout with pneumonia, which I'm trusting by my latest numbers and everything else, I am pretty much on the mend. So thank you, everybody, for your kind words and your support that I got through all of your comments. I really do appreciate that as I, again, now move forward with this big picture update. I'm going to start here with the SPX. Again, crazy week. We saw everything every which way and sideways. But being not able to make a lot of updates did put me into a position where I could go back, really take a look, and tear down once again my big picture. So I'm just going to go back. I continue to leave in place the all-time highs as the completion point for an intermediate fifth, primary fifth, and cycle fifth wave, and super cycle wave 3. This is the SPX. So what are we in? A super cycle wave 4 correction. What's going to be inside of that? Well, an ABC on a cycle degree. What's going to be inside of that? Excuse me, an ABC, a primary degree. What's going to be inside of the first one? An ABC of intermediate degree. So I have been suggesting that our primary wave A completed at the October lows. I'm now willing to put that on as a firm low for primary wave A. We had been suggesting, at least in the S&P, the possibility I could shift it over to the June low and making this all one big triangle pattern. I didn't like it, and primarily because this continues to count best as 5 waves. So I redid the count in terms of that wave A is 3 waves, the intermediate wave A. And inside of that, minor A, minor B was my first hint of absolute confusion coming because it was an irregular corrective pattern right out of the gate. So that seeing now, because I would not have really looked for it before, but then they started to show up on lesser degrees over and over and over again, all through this process. And when I went back and I thought, well, wow, take a look at that. It is an irregular B wave. So A, B, and this is 5, C for intermediate A, ABC for intermediate B, 1, 2, 3, 4, 5 for intermediate C, completing primary A. What that then puts us in is a primary B wave counter trend rally. The trend is down, folks. So this is counter trend. What's going to be inside that primary B wave? 3 waves labeled ABC of intermediate degree, of which we have intermediate A, intermediate B. Now, I really had left it here. I've taken away the trend lines, which still are valid as trend lines. Not that they're going to dictate the triangle, but as trend lines showing that the market is wedging higher, and that can fit. So if we're done with intermediate A and intermediate B, I'm going to drop down to our daily chart very quickly. And now here we have those A and B, and we're in an intermediate C wave up. What's inside there? 5 waves of minor degree. It became very clear after that low and these rallies, I got to go back and clean it all up. And actually, yes, it was that little move. On the daily, doesn't look like much. If you were there, it was huge. So inside, intermediate wave C, 5 waves of minor degree. Here we have 1, 2, 3, 4. And 4 just bottomed, truly, folks. 4 just finished on the 26th of April. Today's the 29th. So this just finished on Wednesday. And now we have the balance. So bring it back down again. Let's go to the 4. And we have, or the 4-hour chart. And we can see, looks the same, but nice and clean. This again, strange but true. We had a lot of irregulars in several different places. See that A wave there? And then we had up and down in a B, irregular B. And again, I can go back and I'll point them all out, but save it to say, they happened numerous times in a B wave, in a second wave, and in the 4th wave. So 1, 2, 3, here's the 4. Let's break it down to the hourly chart and we can see what is the progress. Well, we're counting 5 waves up. And if this is -4 is up here, I'm going to leave it because the minute I open my chart, it'll shift again on its own. But just for the argument here, let me just move this up so we got it in the right place, right there. And then what we got going on now is a 5th wave, a minor 5th wave. What's inside of there? 5 waves of minute degree. So a little bit harder to count on this chart, but leave it to say that all the way up to here was -3. This turned into -4. We're in that minute 5th wave. Either that or it happened here, I might add. So we are in that final stage, but here is some good news. We were looking for, and I got to open this up just a tad. I got to go back to my 4-hour to show you wave 3 topped at 41.68. I didn't need to go out that far. So what we needed to get above now is above wave 3. Where are you, wave 3? Here you are. Whoa, I knew I could find it. So that's at 41.63. Remember, basis SPX, the cash market. Our high on Friday was 41.70. We are above it. So what do we look for in a 5th wave? Well, we're looking for where the market, the wave 5, goes above the high of or the low of the 3rd wave. We now have achieved that. Maybe that 3 belongs over there. That's a 3 up. So that's another irregular, as busy and as wild as it is. So we can call the orthodox top 41.63, 64. And now we're really heading up into that conclusion. Now, let's open this up. I want to put on, again, I'm going to do this basis, the SPX. So ES is going to be a little bit different. But now I want to just start building some fibs for us to take a look at this thing. And I'm going to go from here up to there, down to here. Now I'm going to drop it back down to the hourly chart so we can see our levels. As we start to come up, we can see it's already almost gotten to the 50% level, which is 41.79. Good deal. We're in that 5th and final. We're looking for some additional rally, whether it comes during Globex or whether it actually comes Monday, maybe Tuesday. So next Wednesday, we have the Fed. So we got a lot of speculation going to be happening in here Monday and Tuesday. They will pull out every single. Fed's got to pivot. Fed can't raise the rates. Fed's got to leave those rates alone. Give us a break. Fed's got to. Now, from what we understand, unless Jerome Powell is going to go back on his word and what he was asked the last time, I believe in January. Gee, Jerome, are you going to have any space where we leave rates unchanged or we actually go into QE instead of QT? And his answer was no. He did not see that for the balance of 2023. Now, he knew about the banking crisis then, just as he knows about the banking crisis now. If the federal government or the FDIC did not jump in until Friday to take over First Republic, do we really believe that it's the Fed, or even it's the FDIC's job, but do we really think that the Fed should come in and rescue all of these other banks simply to avoid what they actually created with their quantitative easing? It's a long story and it's a complicated story, but it's real. So speculation alone could drive this up to where wave 5 would equal 0.618 of wave 3. Now, let me just show you, or let me just tell you what we really have. If we all study Elliott and we look, what does Elliott say about 1, 3, and 5? Well, first thing it says is wave 3 can't be the shortest wave. Wave 3 is most often the extended wave, or it's a wave that breaks into its own internal 5. more than once. Okay, so those are the things. So, but wave 5 as related to wave 1 most often can be equal. So here we have a low at 38.08. I'm going to make it 09. And the high, 39.36. 39.36 minus 38.09 is 127 points. Is that right? Was that 38? And it's actually, I want to go right to that one. I did that wrong. We have 39, 38 minus 38. Oh, oops. Whew, 39. Let me get this right. I'll get there, folks. 39. Oh, excuse me. 4,009. 4,009 minus 3805. Ah, man, this thing is going to drive me. 4,009 minus 3805. So it's actually 204 points. I thought it was. I knew that number. And if we had to add 2,004 points, we're going to add it to that low at 40.49, 40.49. And we get 42.53. We're back right there. We have fibs right there at 42.53, right? So once again, we're going to go to this low, the low of wave 4, 40.49. And we're going to add 204 points, 42.53. We got pretty close to just capping out here, at least getting it above wave 3 cleanly, which I'm still thinking we did. But we have resistance at 41.76, 42.11 or 07, I think that is. Let me go right up there. Come on, one more. 42.10. Then we have 42.32, and then we have 42.53. So those are the fibs on wave 5 compared to wave 3. And then outside of that, we have where wave 5 equals 1 at 42.53. Now that number, along with the fib, line things up pretty cleanly. Now that could also suggest quite a few things. But we've been having some very, very strong rallies in the SPX. A couple of days of 50 points, right? That one was, I think, 75. Then we got 32. So we already moved 100 in 2 days. Can we move 50 more? Actually, a little bit more. Another 70 in 2 days? Sure. Why not? So technically here, more important, folks, more important will be the structure itself. Again, we're looking for 5 waves up to complete minor 5. But there's our picture. There's our story. I'm going to slip over. Okay, moving averages. Yep, you can see they're all in alignment. That's my daily chart. I can bring this down to the hourly. We're all in alignment to continue to go up. Going over to the NDX. In the NDX, it basically is the same story. Let me open this puppy up to my weekly so I can show you the same deal. 5 of a super cycle wave 3. And then we have a little bit different, but pretty much the same. Minor 1, 2, 3, because that breaks into 5. Again, with an irregular. And then we have a 3, 4, 5, intermediate wave A, ABC, intermediate wave B, 1, 2, 3, 4, 5 coming down, intermediate wave C, primary wave A complete. Primary wave B now in action, and we have an ABC, that is for wave A, and ABC, that is for wave B. Okay, get out of the weekly, bring it down to at least the 4 hours so we can start to see what's inside. Here's the intermediate A, here's the intermediate B of primary wave B. Now we're in a 5-wave structure, which is complete intermediate wave C. We have 1, 2, 3, 4. Wow, same deal. And massive rallies, same deal. Let's lower, take a look at the hourly chart. Gap 1, gap slight down. So we can't, I don't know if you want to call that a gap, because we're looking for 1 gap, 2 gap, 3 gap. We're not quite getting there, but we'll see what we can pull together. If anything, I can say 1, 2, 3, 4, 3, 4. So up in there, that was a wild and woolly day. This, I believe, was just prior to, what day was that? That was the 23rd. And this would have been when, no, it would have been on Thursday. So this would have been Thursday. That's Friday. Here it is. We had, this is just prior to Amazon reporting. And this was immediately after Amazon reporting the next morning when it reopened. So what can we say? 1, 2, 3, 4, we're in the 5th. Now, let me back out to that 4-hour chart and let's start to build what we can possibly look at here. I'm going to go from there to there to there. Oops, that didn't work. Let me get rid of that and try it again. Let me open it up a little bit so I got a cleaner shot at doing it and catching my anchors. Okay, we're going to go here to here to here. Okay, so same deal. Wave 1, very small. 12,078 on the top side. And minus, oops, tell me what it is. That's going to be minus 11,695. And that's 383 points. And now we're going to tack that on to 12,007. I'm going to call it 25. So we're looking at 13,108. Boom. We're already way past that. So my next would be that wave 5 is equal to 0.618 of wave 3. A lot of people tell me that's not a part of Elliott. It is a part of Fibonacci. And it's a part of a relationship that I have seen develop over my 35 plus years of using Elliott and Fibs. So we are next up. So again, we're looking for the development and the completion of 5 waves inside of here. I got 1, 2, I got a 3 and a 4, and we're into that 5th. Could we have finished it here? Yeah, we could. We could. We got back above, on a futures basis, back above 13,000. On the basis of the cash market, we actually need to get above 13,185, which we have done. So in cash, we broke above 3. Wave 5 has broken and put in a high above 3. Can we be done? We can. We definitively can be finished anywhere in here. So could it be done? 1, 2, 3, 4, 5. It could be. It could be. Well, we're going to continue to allow for upside because of we have what we got coming to start next week. So we may see continued rollout. We may see continued fallout. So again, we're going to see how this all plays out. And moving averages continue to point higher. That's on the hourly. Let me slip to the daily. In the daily picture, they actually do, but you can see we got some slow pokes way down here, but they are angling and moving higher with the 20, the 4, and the 8 doing all the work. It was not the most bullish of bullish bars on the daily on Friday, but continued to show a path where we have upside room. But the NDX may be reaching a very important, slightly longer term top. Finally, as I've put the 4, if we put the 5, it's going to complete minor 5, it's going to complete intermediate wave C, and then it's going to complete primary wave B. Let me jump over to the interest rate sector. And but primarily, we start with the 30-year bond. Bond market has been very, very cagey. And I know I have not updated them in terms of a big picture update, so I'm going to start there. That I've revisited my account, and the primary reason that I did that is I'm going to go and show you 30-year, do it differently, 30-year market yield. So if I bring this out and I go really to the monthly maximum so I can show the whole deal, here is that first 5 down in yields. So we went from high interest rates back in 1981 to the low, which was 1.19, actually it was 1.17 in the 30-year bond, 1.17%. So out of this, we need to, if I'm going to stand in agreement with the bond market, we need to complete 5 waves down in the bond price, which would produce 5 waves up in the yields. And then I came over and I looked at this and I only could do 3. No matter how hard I tried, it'd still come up with 3. And we were getting stuck here without really being able to go up or down or do nothing. So it's really, in my mind, it's correction. It's a wave for correction. So that stunned me. And so I'm thinking, well, we still have one more jump before we drop. And see, that would then put this into a primary, an intermediate wave A that I'm looking for. And then we get that primary B wave counter trend rally in the rate, which means rates go down. Counter trend rally in the bond price, which means bond prices go up. So if I'm looking for this, I think, well, where could we end up? Well, here are the fibs for a wave 5. Again, if I had to do 5 equals 1, get out of the way. Because what we're looking for is at least a 75 basis point hike off of this level. But what we got is 4.83. Let me get this down. 5.2, 5 and an eighth, 5 and 2/3, or 5 and a quarter, 5 and a half, 6. If it's going to be a full-blown 100% of this, we're looking at 6%. Coming in underneath it, we're looking at 5%. And I think that 618, which is equal to about 5 and an eighth, that seems pretty fair. And on an Elliott basis, we look for a 5 stage rally. Up in rates, up, interest rates higher. So moving back over to the bond price, what essentially we're going to be looking for, I'm going to move it back over to my daily, right? If this is 3 and that's the 4, I'm looking for the bond prices to sink. We had a pretty strong rally on Friday as they kind of just moved back in and they did what they did. You know, when markets start to feel that there's trouble in paradise, there's the run to safety, they call it. One of the places people love to run is like to throw their money into a 30-year bond, 10-year note, put it in there, capture that rate. If there's going to be unsteadiness in the equity markets, get out of equities and put it back into bonds. We saw that happen, then we saw them take it out again, then we saw them put it back in. So it's a lot of I have no idea. But bringing it down to the 4-hour chart, I kind of get, right, there's 4. So what am I looking for? 5 waves of minute degree down, ultimately ending up a ball below 117. Well, here we go. We have 1 minute. So what's going to be inside minor 5? 5 waves of minute degree. There's minute 1. Here's minute 2. What this was, just kind of a cagey little regroup. There, I can even bring it down to an hourly chart and open it up in here, right? 1, 2. Strange. It's not pretty, but it works. And this is not very pretty at all. So again, looks like we'll start to head lower and then eventually end up down. Again, 7 and the 10-year note. Actually, hold on a second. Let me go one more time. Take a peek, because I marked this stuff out here on the 30-year bond. So in 1981, the high was 14, almost 14 and a half. The April 20 low of 2020 was 1.17. And you can see how we're now just kind of playing around. Trying to get back towards above 4. Beginning of March, we got back above 4. That was just a finishing up of inside this fourth wave. And now we're still fiddling around 3.667. I would suspect that this begins to drop again. And we head back down towards 4%. Possibly even a little lower, as we just showed you on the rates. Over in the 10-year note, it is pretty much the same thing, where we have yields. The yield on the 20th, on May the 4th of 2020, so we're almost 3 years later, the rate was 0.69%. At the end of April, it was 3.53. We did kind of touch upon 4.25 at that October low. I think we go down and break that October low. So I think we go back to 4.25, slightly above all that. Bringing it down, let's take it all the way to the 4-hour chart. A little bit more difficult, very cagey, but again, wave 1, wave 2, getting ready for, I think, a nice solid drop down. And then finally, we have the 2-year. The 2-year note, a little bit different of a count, because I believe it already has put in an intermediate A wave. And so it already put in its 5th wave, 4 and a 5. It did go down, make new lows. And this would have been back in March, the beginning of March. So we got that initial whoa bounce. So what am I looking for now? I'm looking for it to come still, finish a B wave, and we have as low as 102, and then actually 102 even, and then 102.148. So we have some support levels coming off, but I think they should contain. B wave, we already know, can come all the way back. If it's going to be a flat, this is only an ABC, so that it opens up that Pandora's box where we can come back down towards 101. And again, putting in another rally, which would then be intending to take us back out of the doom and gloom. And let's kind of move over and take a look at gold. Gold doesn't like the gyrations in the dollar. Dollar up, dollar down, dollar up, dollar down, and we're seeing that kind of play out. And the current count, I still believe we have 1, 2, and then we put in the next one. So that's 1 of 3, and we're still in 2 of 3. Difficult as it is, it's corrective. Where do we have, so if anything, this could be a very strange little triangle pattern for wave B of 2. So I still believe that in gold, we have a fairly, I'm going to give it, I tend to, because it is gold and it's really hard to pinpoint exactly what's going to motivate people on what day, that a 50-50 shot that this turns into a triangle, we put a B there and we slide quickly, like in here. And from our current levels, and he would say we could drop 100, but I'm going to put it down at 1945 to 1918. That'll shake it up. That'll be like, oh, what was all of this? Let's keep in mind, Elliott, ebb and flow. And again, what do gold traders really don't like? Well, they're not big fans of inflation, but they're not big fans of a running dollar. A lower dollar will give us a nice strong rally. If the dollar should turn and rally with any intensity, I would suspect that gold could drop a clean 100 from where we are. And that would bring us back to here. If not, at least 50 to 70 points, $70. So gold, While I still maintain a longer-term bullish view in gold, I suspect that after when all this correction is done, we will move into a level where wherever it ends up down here, it'll be a massive rally to get it back above 2,000 and then on and above the recent highs at 260. And that actually is 263. And then up towards upper levels, which I will put back in once we break back above and are done with this correction. But we have levels take us up to 2,100, 2,200 pretty easily. Last on my list today, and thank you all for listening, is the dollar index. Oops, that didn't work. The dollar continues to roll around the lows from February. So in February is where we reached down, excuse me, and got to 100.836. And we put in a nice rally. So again, what I'm looking for here, that's the A. I'm looking for a B wave. I'm looking for a B wave, and these are my levels. I still think we need to get up and get above that 105, 105.78. Well, let me show what it is. Come on, tell me. Right there. 105.88. So I'm looking for it to get up there, get above 106, again, for a B wave, to finish a minor B wave, right? So this is the A, this is the B, and we got to do 5 waves up. But it's laboring down here. It's not able to get anywhere. We go back up to 102, we come back down to 100. We go back up to 102, and that's all we're doing, chop-chopping away. Now, we're sitting on the fence. There has to be some type of input. There has to be some reason for the dollar to start to really crank it up. One would be, well, a little adjustment in interest rates to the upside. Bing, 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 bing. I think we can get a good rally going. And it'll be interesting. Eventually, let me just say, A, B, C, the next leg would be a nasty decline in the dollar, which would then coincide with a strong rally in gold and other precious metals. And I think that's all coming. I think that we will get there. But right now, we're still in this correction. Right now, the equity markets are still fiddling around. Are we in a bull market or bear market? It's like, hello, look at the facts. Look at what's really happening. Go behind the curtain, and you will get your answers. Now, patience is a major factor in a trader's life. Without it, you're going to jump in early, get all pissed off, get angry, call your analyst or whomever a nutcase, because what do you know? I keep losing money. Everything is in its due time, folks. When the market wants to ignore the signs, when the market wants to focus on yesterday's earnings, what can you do? You can play along. I am going to start really enforcing that one again. And I'm going to have more. Yes, new trade rooms are coming. And it looks like we're going to try to put together 2 in 1. So it's going to be interesting if I can get it all together along with Dan Ascani. So stay tuned. We're going to have a lot more information about that, and it is coming very soon. It is something we do want to get launched. Now, I'm going to conclude here. Next week, folks, we got the Fed on Wednesday. We got Apple on Thursday. We got a couple other companies that are going to be coming in on Monday and Tuesday. It's going to be another very, very interesting week. Stay tuned. Stay tight. Please obey, pay attention to your own trading rules, and always, always, always work with a stop. Have a great trading week. Thank you very much for your time today. There will be an Elliott Wave update tomorrow after the Globex starts.